Good morning, everyone. So this is our lesson for week 3. We are coming into a point now here where this particular lesson will be a little bit shorter in length, and rather we will be looking at the actual contributory income statement much more and working through it during this video a bit more in depth. So let's start here. Let's go through where we left off last week. I also have some tips for you as a potential college millennial or also just someone that's leaving college and going to be starting to make more money and how to use your money a little bit more effectively. And then we will also go over the stockholder, shareholders, equity statement a little bit more in detail just because that's one of the more confusing parts. So last week we looked at a portion of a horizontal income statement, and this is what we're looking at right here. And I'm sorry, I'm going to move my camera a bunch. And this is a way that we set up income statements to see how we attribute different expenses to each different department. So you will see here there's a dining area, a banquet area, and a beverage area with the totals of all of the money that they've made as well as all of the dollar amounts that they've spent. Now the term contributory income is the amount each department contributes to total revenue. Same thing here at the college. Each school, hospitality, tourism, and recreation, has a specific amount that they want us to contribute to the entire college as a whole. You'll also see it's broken down the expenses and all of their costs based on each individual place. And we'll show you a dollar amount at the end. And just by looking at this real briefly, I could tell you that the beverage department is obviously making or contributing the most money to the actual overall property. Next slide. So this is the rest of that vertical income statement that we were looking at. So again, it has all of these different expenses, some of which are either being charged directly to the entirety of the company, others that are just going to be split up in between them. But we do have some undistributing operating expenses, which would be very difficult to assign to a particular place, as well as some fixed charges. Again, very difficult to assign insurance and interest and depreciation to a dining room versus a bar or versus like the rooms division. So as we go through this lesson, you will see that I will bring up and give you a way of how we would split those up. Next slide, let's go. Okay, we also looked at this. So this is like your very generic income statement formula. So this is one for contributory income statements. So it starts with the department revenues minus all your department expenses equals your contributory income. What does each department contribute? Like we said before, this is very controllable by management. This is where you will see your effect on the business. Then from there, we subtract all the undistributed expenses, the indirect costs. This gives us a gross operating income or profit. Then we subtract all the fixed charges, so things that we have no control over, like the interest, the insurance, things like that. This gives us income before income tax. Then the tax man comes. Depending how much money, the tax rate will go up. So if you make a little bit of money, you have a small tax rate, and the more you make, unfortunately, the higher your tax rate is. And that will give you net income or profit. The tax will never be so much where if you are making money here, you will never lose money. And if you lose money, they won't tax you because you're already losing money. Moving on. We also looked at inventory valuation, which as we started to go through it, seemed very difficult and people were struggling. Also, the format of Excel you had to play with a little bit. But as we went through it, you started to really understand how it works and why it works. And we went through FIFO. LIFO is something we did not look at, but that is the fourth. And no one ever uses it really. Maybe furniture salesman. We went through weighted average price and then also latest purchase price, which is the easiest way to do it. Now here, we're going to stop for a little advertisement from your money tips from a college millennial. Coffee, not alcohol. So a money must for you, number one, is please have a budget. I don't care if you scribble it on a napkin or if it's this beautiful Excel sheet. have a budget. Try to go more than a couple months in advance. Weekly budgets don't work because we don't usually pay our costs weekly. Usually we pay rent every month, or insurance, or a car payment, whatever it is. So some people play by the rule of 50, 15, 5. So 15% of your income's on essentials, living, and this could be food, all of the things that you need, your cell phone. 15% of your income's on retirement, and 5% of your income is on short-term savings. Now, the other 30% is on whatever you want. So this could be your miscellaneous, you need to pick up some new clothing, right? That's not necessarily an essential. Or you want to go out for a nice dinner one day, hopefully soon. And that's where that 30% is. That's a realistic budget that you can actually stick to. If your essentials cost more than 50% of your income, then you need to take away from that miscellaneous. Try to keep that retirement short-term savings money still being put away. And then eventually, if your percentage of income on essentials is so high, then you really need to start looking at, how do I either make more money or cut some of my costs? Money must, number 2, is a bank account is a must. A credit card is not always. So much things about credit cards is that we have high interest rates, which are, in my opinion, near, they should be illegal. 25%, 28, 29% on a credit card is literally killing people with interest. And it's not fair for them to even be able to grant you a card with that amount. So credit card minimums are set for favoring banks. So if you only ever pay the minimum off, you're paying the credit card off over like 20 years. So essentially that bank is just saying, I just now have this person on the hook. They're going to pay the minimum, and I'm just keeping their money. And they're going to keep paying and keep paying. Now, there are a lot of student accounts. They do work similar to a credit card. Credit cards are not for financial newbies. So you need to have some skin in the game, some years using expenses and understanding how credit cards work, and that they are meant for a short-term purchase that you do pay off by the end of the month. Now, many people don't. I've been a victim of that as well, but please take my advice when I say, don't use a credit card to buy something that you do not need, unless you have the money in cash and you just are using it to a method of payment. Money must, number 3, there's always room for saving. So a lot of my students say they don't have any money. It doesn't matter. The change from your pocket when you go out. Don't spend change, only spend bills. Keep the change and put it away. $10 a month, $20 a month. These will start developing those really good habits. And as you know, such as eating healthy and working out, it's all about routine and setting habits. Have good financial habits. Open a TFSA account. So it's a tax-free savings account. They are amazing. You need to open them up as soon as you can. And once they are open and you have your room to invest in there. So there's only a maximum that you can invest into a TFSA. I think it's like 60,000 right now, but it starts at 5. So every time you open it up, it will slowly increase over time, right? So if you are waiting to open it up, you are losing some of that contribution room. RRSPs, which is a registered retirement savings plan. You might not know much about them yet. They are really only useful for, in my personal opinion, for high income earners. So people who are making over $75,000, $80,000 a year. Or if you, for first time home buyers, because you can take that money out. But right now, I would say TFSA, open it up, small amounts, $10, $20, and then we can start thinking about putting that money into something else. Number 4, no one does this. It's ridiculous. It bothers me. Check into scholarships. So Georgian College has a lot of scholarships, like $700,000. I think it's close to up to $1 million now. They also have free bursaries. I put this up on your announcements. There is no reason that you shouldn't be getting $500, $1,000, $2,500. And if you're a good student and you have great grades and you volunteer for stuff, $3,000 and $4,000 and $5,000. Yeah, you need to fill out an income statement or a budget for yourself. Yeah, you need to get a couple people's letters of reference. But this is very doable. It's a couple hours maybe of hard work, and you will earn potentially thousands of dollars. that's a pretty good hourly rate. So look at them, apply for them. International students, check all of these Georgian websites as well. Check your own local government and townships because they do have those. And these are not the only scholarship things that are out there. Scholarshipscanada.ca is another website that you can go to, and they have plenty of money to give away. Many of this, or much of this, goes unclaimed. Take advantage of your college discounts and perks. So if you are an alumni or a student of the school, there are a lot of different services that are actually, like, they give you some discounts. Johnson & Johnson Insurance, or just Johnson Insurance, I believe, gives you 15 to 20% off your car insurance. That's your $10 or $20 a month that now can go into that TFSA. And you didn't do anything, right? You just found ways to save money. So do your own research. They call it do your own DD, your due diligence. Look in your cost. Is there someone cheaper? You know, if you're with Rogers, well, they'll give you a better deal. At the end of the day, if it's putting more money in your bank, it's worth the time to investigate. Opt out of services you don't pay for. I have seen so many people go and pay for a gym membership and never go to a gym. So if you're not going, well, obviously right now you're not going, but if in the future, if you're not going to actually go, then just don't pay for it. This gives you an idea of graduates who owed money for their education according to any source. So in the year 2000, 49% of graduates who owed debt to the source of graduation. And the average amount was $12,700. Now, as you can see, every year this has gone up. As you probably noticed, tuition every year goes up. The percentage of graduates with debt who had paid it off at the time of interview has gone up as well. So people are starting to understand their money savings a little bit better. But the average debt remaining is still very high for those. If you don't have to take money while you're in school, please do not. If you have to take it, it's not free. I did it. I got OSAP, and it wasn't much, but my final year, they gave me something like $10,000, and I wasted half of it. I'm sure I did, if not more. And it took me till I was over 30 to pay it all off. So just be careful about that. Again, this just gives you, this is just a slide giving you an idea of your percentage of monthly budget and what you should be spending money on. We talk about personal budgets as well as business budgets. Personal budgets are for you. Business budgets are kind of a cash flow statement. And this will just give you an idea of the things that you should be setting aside on how much. And I know for a fact there's some of you who pay more than $80 a month on clothing. And there's also some of you who haven't bought a new shirt in 6 months. So to each their own, but take a look at this, understand where this is coming from, and try to stay within that budget. So often as we all graduate, we decide that we need a new vehicle. It's an adult decision, and they say, hey, I'm going to go buy a brand new vehicle. It's well worth it. I have a job, I need it. So purchasing a new vehicle once you graduate. There's a lot of great 0% financing options. They give you a free loan and urge you to take the longest payment plan available. Now, this is something that we like to think about as a depreciation graph or depreciation chart. So Mitsubishi Outlander cost $32,000. I bought one. Plus taxes, freight, I did a little upgrade, so I had the navigation and all the good stuff. It cost me around $40,000. The payments were no interest, which is what I was looking for. So it's bi-weekly $229. So as you can see, I am at this 2021 period of time where I have paid off almost $30,000 of my vehicle. The actual amount was about 40. It was a little over 40, but I owe about $10,000 left. So this is how much I pay every year. And I'll be honest, month to month, this is my second largest bill. Like, other than my mortgage, this is it. This is where a lot of my money goes to. And I kind of wish I would have done something different. But I didn't have any money up front, and I wanted something nice. They'll also show you the depreciation amount. So depreciation is how much your vehicle loses its worth over time. I have, been pretty good on it. I haven't driven a whole lot, but it really doesn't matter. this is the set standard as far as percentages on how much it loses. So in the very first year, I lost $16,000, essentially just by driving it off the lot. It was worth $24,000 if I wanted to sell it, but I still owed 34. So they call it upside down. So what I am worth, I owe more money on the worth of what I own. It's not a good place to be. So here, now 2021 and the start of 2021, I'm still at that point where if I sell my vehicle, I might get $9,000 for it. I still owe 10. I'm still a little bit upside down. I won't quite get my money back. It won't be until next year sometime that it'll be now worth more than what I owe on it. And eventually, even after I pay it all off, it still will only be worth $4,000. The real savings is every year after that now is where if I can still keep my vehicle on the road and still keep it running, and I'm saving $229 every 2 weeks, that's where I can start really saving some money. But then I'll get that itch for a new vehicle. So it's going to be my job to try not to splurge and get the new Ford Bronco that's coming out because it looks awesome. Statement formats. So we looked at a couple things, but I want to look at the formats of statements to understand how they are developed. So all statements have a similar format. And by statement, I mean income statement, balance sheet, statement of owner's equity, or change in owner's equity, these things. So they all start with these same titles: the company name, the type of financial statement I'm looking at, and the date range. Now again, if it's an income statement, it could be a week. If it's a balance sheet, it's a particular time. So as of December 31st, 2020, or it could be for a quarter of a year or a half a year, whatever it actually states. So this one is for a strange amount of time. It's for 5 months. This is followed by the particular finances, such as this one here, which is revenues and expenses and net income, and revenues, the different expenses, and net income. We also know that we can break both expenses and types of revenue down into smaller sections. So this is a very basic income statement. If I was the owner of the company, this is something I might send to an investor. But for me personally, I would want to know, okay, where is all my sales revenues coming from, and where did the cost of these goods coming from? While basic statements are easy to read and understand, we miss much of what it is saying. So breaking it down into smaller sections help us. Hence, the current liabilities and the current assets are one of those ways that we break it down into smaller sections. And we can talk about the immediate debt that we have, which is within 1 year. So this year, I'm going to have to pay off $50,000. And the immediate assets I have $39,800. They do ratios. We're not on ratios yet, but one's called a current ratio, which is your current assets divided by your current liabilities. If it's not over 1, people generally don't want to invest in you. It's not a very good company. Because what's that saying is that if it's not 1, so 39,800 divided by 50,450 would be like 0.75 or something. That means that I could only pay off about 75% of my current liabilities if I sold all of my current assets. So if I do sell tomorrow, my whole company, because something happened, I'm going bankrupt, I would still owe more money. So you're looking at this, your total assets are 171,900, liabilities 149. They're very close. There's not a lot of worth to this company. So if I wanted to sell my whole company, even Paul's Guitar Shop, even though I thought I had almost $200,000 or $172,000 in stuff, in assets, I'd only really be worth $22,000. And that is only if I'm able to sell everything at the amount that it should be sold for, not the market price, which is not always the same. So this is the statement of shareholders' equity. So they're talking about their paid-in capital, so how much money was invested. So this is a 9% preferred stock, $100 par. So what that means is $100 par is that each share is worth $100. There's 300 shares authorized and issued. Preferred stock is like an elite stock. It's only meant for like ownership and very specific people. Me and you could not just go and buy that. We can go buy common stock. So they're saying this common stock has a value of 10 cents. They've issued 10,000 shares in which that they want people to go and purchase. So let's say all of us go and purchase these 10,000 shares, 2,000 shares issued and outstanding. They were worth $200, which is nothing. It's not really a lot of money. Now, the paid in capital in excess of par, par being 10 cents, in excess of par, is worth $49,800, meaning that since this company has originally issued those shares at 10 cents, they have gone up and up and up and up, and now they are worth, I need a calculator, hold on. So if you were to go buy these today, they would now be worth $50,000 divided by 2,000, $25. So if you bought it at 10 cents, they are now worth $25. You would have made a lot of money, and you would feel fantastic about it. So this is the in excess of par. We started at 10 cents each. They've gone up to $25. 2,000 shares at $25 is $49,800. The total paid in capital is all of the money that we have gotten from our preferred stock, and also from our par stock, and then also what the worth is now today in the market value. So we have $80,000. Retained earnings, again, like we said, is that money that they're holding on to that they want to spend in the future. They want to invest in something, or it's for research, or they have some sort of financing loan payment that they want to put it towards. They're not paying it out as a dividend. They're keeping it. So we have a total stockholders' equity of $108,000. If you just listen to what I said and go, huh? That's okay. This is not something that you're going to get overnight. This is something that you have to read and understand and look into. And at any time, if you just look up like a different stock that's out there, Apple or Tesla or Facebook, whatever you want, start taking a look at all their financial statements. You'll see that they're much more, even more complex than this, but it'll start giving you an idea of how business operates in the world. And you will want to be a part of that one day. So, maybe baby steps right now, but you want to slowly start getting an idea or getting your head wrapped around how these things work, because they work the same in every country. So this brings us to contributory income, and that's what's going to be a part of our assignment for this week. So this is a way of presenting an income statement which fixed costs are shown as a deduction from total contribution. When determining contributory income for individual departments, we must determine a way to break up indirect costs. So how do we say marketing? We have a resort that has a golf course, a dining room, a bar, the actual rooms itself. So marketing, we market the whole property. We pay for a website and social media managers. So how do we determine who pays what out of this amount? So when I say think of a resort with a golf course, hotel, F&B, and spa, how would you split up like a maintenance cost or a marketing cost? And this is difficult. So there's a couple ways that we can think about it. There's two generic common ones that we do. One, we use sales revenue, and we find it as a percentage. So here as an example, the room's revenue is $465,000. The total sales revenue is $1,245,000. So our contributory income is 37.35%. That is contribute 37 and change percentage of all of the revenue. Using this percentage, we can then multiply all the indirect costs and determine the proper amount to split. So if our marketing is $24,000 and we want to say, hey, or our maintenance $128, utilities, let's multiply all of these amounts by 37.35, and this is what we will apply to the actual room's revenue department. So from their $465,000, we will subtract these amounts. Okay, and that's one way that we can determine how to split up indirect costs or fixed costs. Next one is using square footage. So something like maintenance. So we looked at maintenance, it was $128,000 on the last slide. Now, a rooms department is very big. It's quite vast. A golf course, very big, vast. A bar, quite a small footprint, not a very big place. So even if the bar brought in 30% of the revenue, should they pay 30% of the maintenance costs or 30% of the utilities? It costs that bar a fraction of the utilities as it does all 150 rooms that have lights and running water and everything else. So it's depending on the indirect costs, we want to look at it and say, maybe it's better to use square footage. So to do this, we need to know the total square footage of the property and the individual departments. So here we have an example of a rooms, a bar, and a catering department. So rooms is 2,400. So this is like a small boutique hotel that probably has 8 rooms or so. Has a little bar area, 800 square feet, and catering's 1,200. To find this, we must figure out what the total square footage is. So we just add these all up. We can determine it's 4,400. 12 plus 800 is 2,000, plus another 24 is 4,400. So 2,400 divided by 44. The rooms department takes up 55% of the entire property. The dining or the bar takes up 18%, and the catering area takes up 27%. So now, using that, now we would go back and divide the particular ones that we want. Sorry, I thought I had a slide for that. So instead of using the rooms revenue and saying, hey, we should pay for maintenance as 37%, the rooms was actually going to be 55% because it's a larger area. That is how we're going to look at it. Don't know I have my last slide, apologize. So from here, we will now go to the assessment. So this will be located under weekly learning as well. This is something that I want you to start on. This is the exact same format as your assignment package. So I'll let you go through this and start breaking it all down. But I will go through a little bit and show you how it's done. You'll also notice that this particular in-class activity, I have new practice assignments for week 1. So this is using different numbers that we used before. Week 2, the balance sheet, using different numbers as well as the inventory valuations. Here's some new stuff. And then week 3. So if you want a little bit more practice on what we already accomplished in week 1 or 2, feel free to go through and work through those as well. Before the test is posted, I will post these answers, give you a few days to review it as a study guide, just to ensure that you think that you're doing it correctly. Okay, so I think we're still recording. Yes, great. So here we're looking at financial management contributory income statements. They have 3 departments, which are shown right here. And what the expectation is of you is that you will determine the contributory income as well as the average monthly figures. If this happens, so I zoomed in and this happens, that just means that there's not enough space to show a number. So I'll just click on this cell and it'll move over for me. So step 1 is prepare a consolidated departmental contributory income statement. It's a mouthful. And we're going to do it side by side so it's easy to compare. So I've already moved the numbers down here for you just to save you a little bit of time. And these are these right here, as well as all of the costs for all of these departments. So here we go. So first of all, it says dining as a percentage of total revenue. So I need to find out what total revenue is. So I'll go over and I will add up all of the revenue departments and find our number. So here we go. It's 389,500. So I will now go through and do some math and divide everything here by total sales as a percentage. Sorry, I'm going to put this down. Okay. Oops. What was that, 90,000? Okay, so now we have these numbers. Now these are all going to be percentages, so I can just go through, select these all. These are percentages as well. And tell it's a percentage with 2 decimals. Okay. So 50.32% of the revenue comes from the dining area, 26 from the catering, 23 from the bar. And here I'm just going to add up all of my percentages. So I want to see, this should be 100%. So yeah, so this is the 3 ways that we have our revenue. They equal 100%, so that's great. So we know our math's correct. And it equals just under $400,000 or just under $390,000. Next one is cost of sales. So dining percentage of total revenue. Now for these costs of sales, I want you to divide it by the sales revenue for that particular department. So $78,000 divided by the dining room. $30,000 divided by the catering revenue. And I want you to do this for all these ones going down. All right, so what we're doing here is finding of the revenue that we have earned in that department, how much does these particular costs take up? So make sure you do that properly. Okay. So now we're looking at our cost of sales, $78,000, which is 39.80. So I can also do some of the math here is I'm going to find out what the gross profit is. And then in this one down here, I'm going to find out the contributory income, which is the gross profit minus the other costs. So we start with 196, which is 50% of the total property's revenue. We spend automatically almost 40% of that 196 on cost of sales, you know, labor and for dining and food probably. Then we are left, so that's all food, so all food costs. Then we're left with 118,000. Our wages are 66,000, so another 33.68. We subtracted from there, and then other direct costs are about 9, and we subtracted from there, and we are left with 34,520. Now you do the same thing with this one. I'm sure there are formulas that would make this easier, but I can't talk and think about that at the same time. So I'm just going through and doing, I did that right, doing the math here and subtracting. There we go. Okay. So as we're looking at this as well, now we can also want to look at our total amount. So we're going to look at all of our cost of sales for the entire property, all of our gross profit for the entire property, all of our wages and salary for the entire property, as well as all of our other direct costs and contributory income. Okay, so now we're looking at here. So the only thing that we need to do is fill out a couple of these right here. We can tell which department is doing the best, which is the bar. And also we can tell based on how much money they're bringing in. So he's only bringing in, the bar, this is a he apparently, he's only bringing in 23.11%, but is contributing a vast majority to the actual whole property. This here, I'm just going to add up these percentages. Oops, sorry. This here, I'm going to use the total amount divided by the total revenue. So this will give us an average of all the departments as a whole. So on average, we spend about 35.29% of the cost of sales of the total revenue. Down here, we spend about 28% as our labor costs for the entirety of the whole building. And then our other direct costs are about 8%. Even though, you know, labor cost in the dining room is 33%, our labor cost in the bar is 14%. And again, we always look at this as an entire property as well as individual departments. So some of the bar costs, yeah, we're not serving any tables, we're just selling drinks. But I'm probably also making drinks for the catering department as well, or I might have a bar in there as well. And same with the dining room. So they work together as well as they are separate. So that would give you our 22 marks just by doing those different calculations. Then what you would have to do is determine the different areas of sales and square footage. It says use these percentages to determine how to divide costs across different departments. Square footage is located above. Use the sales or revenue for the other. So it says allocate the indirect expenses, the divisions, and prepare a departmental income statement. Administrative and advertising expenses are allocated to sales revenue. The remaining indirect expenses are allocated on square footage. So which ones were they? Administrative and advertising. So I might just even go here and say sales, and these are all going to be square footage, just so I remember. Okay, and I want to know, are based on sales revenue, so I look at the percentages, and that's how I'm going to allocate the costs. Okay, so sales revenue percentage, 50%, catering, and bar, and then total. Square footage is 3,000, 1,500, and 6,500. So I might just I can do it anywhere. Again, Excel is just a big calculator, so I'll just do it right below. So I'm going to go through, well, that won't work. I'll go 3,000 divided by 5,150. And 1,500 divided by 5,150. And 650 divided by 5,150. So 5,150 is a total square footage of the whole area. These are percentages. So I'll go down here now and just hit equals and get this number. So these are showing up not as percentages, so that's fine. I'll just move it over a couple decimals, and you know what, just to make sure that they are all going to equal 100%, I'll add them up. And here we go, 100%. I hope you're still with me. Okay, so last part. So now we have these costs. Now the total costs are up here. So administrative, what I can probably do as an easier option is just copy and paste all these, bring them down. Let's see if it'll paste. No. No, it doesn't. But we know this is $12,000, $10,500, $12,000, $5,000, $13,000. All right. And the total, which is the sum of all of these. Again, formatting, we can say these are all going to be dollar amounts, so we can just change that to dollar. And now we're trying to determine, of this $12,000, how much is going to each different department. So what I'm going to do is take this $12,000 and multiply it by these percentages. So first one, $12,000 multiplied by 50.32. Catering, $12,000 multiplied by 26.57. And same thing with bar. So that will be all equal $12,000 total. Down here, I'm also going to do this, but now I'm going to do this for square footage. So same formula style, but instead I'm just going to use the square footage as the cost. Like so. So the $12,000 is split up now based on square footage. So using the other sales and the other square footage classifications, separate these costs right here by the percentages and find out the total that each department is going to pay. So of the $57,000 we have here, we need to break this up, and then you will pull our contributory income here, subtract it by the total expenses for those departments, and find out how did each different department do at the very end. So then we're going to figure out our totals. At the very end, I want you to look at this particular place, find 2 problems and 2 possible solutions, and I want you to put as much detail as you can in this. Now, as this is a practice assignment, I can look at them. There's so many different areas that I would look at, but during the test, I really am looking for a little bit of detail, identifying where you see a problem, why is it a problem, and then also what could be the possible solution. So I will leave you with that. Thank you very, very much for tuning in. How do I stop this? All right. So this is 41 minutes of a lovely contributory income exercise. This is week 3 financial management. I will see you either on Monday or Wednesday. Please watch this lecture in advance. And if you are hearing me, I'm sure you have. Practice the assessment or the in-class assignment. And we can also go through it again if you don't understand during class time. Other than that, I'll see you soon. Bye.